A quiet revolution is unfolding across the Atlantic, one that could cost the United States billions, reshape the global energy order, and turn one of America's closest allies into its fiercest economic rival. Europe has made a choice, and Washington is about to pay the price. Act 1. The breaking point. For decades, energy has been more than just oil and gas flowing through pipelines. It's been leverage, it's been influence, it's been power. And for years, the United States wielded that power with precision, using its vast reserves of natural gas and oil to shape alliances, dictate terms, and keep friends close. But something has changed, something fundamental. And it all started with a war that wasn't supposed to reach Europe's doorstep. When Russian tanks rolled into Ukraine in early 2022, the shockwaves didn't stop at the battlefield. They rippled through gas pipelines, electricity grids, and heating systems across an entire continent. Russia had been Europe's primary energy supplier for years, delivering cheap natural gas through a vast network of pipelines that stretched from Siberia to Berlin. But as sanctions tightened and Moscow retaliated by choking off supply, Europe faced a nightmare scenario. Winter was coming, and the lights could go out. In those desperate months, the United States stepped in. American liquefied natural gas, LNG, began arriving by the shipload, filling storage tanks and keeping European homes warm through one of the coldest winters in recent memory. Politicians in Washington celebrated. The American energy industry boomed. It looked like a textbook case of allies helping allies. The U.S. had saved Europe, or so it seemed. But behind closed doors, a different conversation was taking place. European finance ministers began crunching the numbers, and what they found was alarming. American LNG wasn't just expensive, it was exorbitantly priced. European industries, already struggling with post-pandemic supply chain chaos, were now hemorrhaging cash to keep factories running. Households saw their energy bills double, sometimes triple. The cost of heating a home in Germany or France had become unsustainable. And then came the other problem: trust, or rather, the lack of it. Every 4 years, America elects a new president. And with each election comes a new energy policy, a new trade agenda, a new set of priorities. What was promised under one administration could be reversed under the next. European leaders began to ask themselves an uncomfortable question. Could they really build their long-term energy security on such an unstable foundation? Could they afford to tie their economic future to a partner whose policies shifted with the political winds? The answer, increasingly, was no. Act 2. The Northern Alternative. Enter Canada, a country that had been quietly watching from the sidelines, rich in resources but underutilized as an energy partner. While the United States had dominated Europe's post-Russia energy imports, Canada possessed something equally valuable, and perhaps more importantly, something Europe desperately needed: stability. Canada isn't just an oil and gas powerhouse. It sits on some of the world's largest reserves of critical minerals: lithium, cobalt, nickel, the very elements that power electric vehicle batteries, wind turbines, and solar panels. As Europe races toward its ambitious climate goals, these materials have become the new oil. And Canada has them in abundance. But it's not just about what's in the ground. It's about what's above it: the political landscape. Unlike the United States, where trade policy can swing wildly depending on who occupies the White House, Canada has maintained remarkably consistent economic relationships with Europe. Agreements signed decades ago remain in force. Trade partnerships are built on predictability, not political theater. For European leaders tired of bracing for the next tariff announcement or policy reversal from Washington, this was a breath of fresh air. There's also the environmental angle. Europe has bet its future on green energy: solar farms, offshore wind, hydroelectric dams. Canada is already there. From the hydroelectric plants of Quebec to the wind farms of Alberta, Canada's energy infrastructure is transitioning in the same direction as Europe's. The United States, meanwhile, remains heavily invested in fossil fuels, drilling deeper and fracking harder. The contrast couldn't be starker, so Europe made a decision. Not loudly, not all at once, but steadily and deliberately. Trade delegations flew to Ottawa. Energy contracts were signed. Ports were expanded to receive Canadian LNG. Supply chains for critical minerals were rerouted northward. What had once been a transatlantic lifeline from America was now being replaced by a northern partnership that promised lower costs, greater stability, and aligned values. For Washington, this was more than an economic setback. It was a geopolitical earthquake. Act 3. The price of losing Europe. The European Union had been the crown jewel of American LNG exports, the single largest buyer, accounting for billions of dollars in annual revenue. Losing even a fraction of that market would hurt. Losing most of it? That would be catastrophic. American energy companies had invested heavily in LNG infrastructure, export terminals, liquefaction plants, specialized tankers, all built on the assumption that European demand would remain strong for decades. Now, with contracts being renegotiated or simply allowed to expire, those investments were looking increasingly shaky. Stock prices for major energy firms began to wobble. Analysts started downgrading future earnings projections. The American energy boom, it turned out, had been built on a foundation that was cracking. But the damage didn't stop at energy. Canada's rise as Europe's preferred partner extended into the automotive and technology sectors. The electric vehicle revolution is the future of transportation, and that future runs on batteries. Batteries need lithium, cobalt, and nickel. Canada has all three, and it's building processing facilities to supply them directly to European automakers. The United States, by contrast, faces significant regulatory and environmental hurdles in mining these materials. Permitting processes can take years. Environmental reviews are rigorous and often contested. While American policymakers debate the finer points of mining regulations, Canadian companies are already shipping processed materials to factories in Germany, France, and Sweden. The U.S. auto industry, once a global leader, is now watching a key supply chain shift north of the border. This isn't just about money, it's about influence. For decades, the United States has used energy exports as a diplomatic tool, a way to keep allies aligned, to shape global policies, to maintain leverage in international negotiations. If Europe can secure its energy needs without relying on American LNG, that leverage evaporates. Washington's voice in European capitals becomes quieter. Its ability to shape outcomes weakens, and other countries are watching. If Europe can pivot away from American energy, who's to say Japan won't? Or South Korea? Or any number of nations that have relied on U.S. supplies but are now questioning the cost and the reliability. The geopolitical order that America has carefully constructed over decades, one where energy exports translated into strategic influence, is suddenly looking far more fragile. Tensions between the United States and Canada have been simmering for months, but recently they boiled over into open conflict. The Trump administration, frustrated by what it sees as unfair trade practices and worried about the shifting energy landscape, imposed sweeping tariffs on Canadian imports, including energy products. The message was clear: fall in line or pay the price. Canada's response was swift and uncompromising. Retaliatory tariffs hit American goods across the board: agricultural products, manufactured items, consumer electronics. But Canada didn't stop there. It began accelerating plans to diversify its energy markets, looking eastward toward Asia. The Trans Mountain Pipeline expansion, a massive infrastructure project designed to move Canadian oil from Alberta to the Pacific coast, became the centerpiece of this strategy. Once completed, it will allow Canada to ship hundreds of thousands of additional barrels per day to China, Japan, and South Korea. These are markets hungry for energy, willing to pay competitive prices, and crucially, not located south of the Canadian border. China, in particular, has emerged as a key partner. With its massive industrial base and insatiable appetite for energy, China offers Canada a customer base that could rival or even exceed what it currently exports to the United States. Trade delegations have shuttled between Beijing and Ottawa. New contracts have been signed. The economic bonds are strengthening. For the United States, this is, frankly, a nightmare scenario. Canada currently supplies more than 60% of America's oil imports, over 4 million barrels per day. Much of this is heavy crude, a specific type of oil that U.S. refineries, particularly in the Midwest, are specifically designed to process. These refineries can't easily switch to lighter crude from other sources. They're built for Canadian oil. If Canada were to significantly reduce or cut off those exports, whether as retaliation for tariffs or simply because more lucrative markets exist elsewhere, the impact on the U.S. economy would be immediate and severe. Gasoline prices would spike, diesel costs would soar, transportation, manufacturing, agriculture, every sector that relies on fuel would see costs rise dramatically. And it's not just about oil. Canada also supplies significant amounts of electricity to the United States, particularly to northern states. Natural gas flows south across the border. Minerals and raw materials feed American factories. A full-scale economic decoupling would send shockwaves through supply chains that have been integrated for generations. The consequences of this trade war are already spreading far beyond energy. In Canada, a grassroots movement has emerged, ordinary citizens boycotting American products. Walk into a liquor store in Quebec, and you'll notice something missing. American whiskey and wine have been pulled from the shelves. Nova Scotia followed suit. Other provinces are considering similar measures. This isn't just symbolic. Canadian consumers spend billions annually on American goods, everything from electronics to clothing to vacations. Florida's tourism industry relies heavily on Canadian visitors. So do California and Texas. If Canadians decide to vacation elsewhere, to buy European or Asian products instead of American ones, the economic impact could be substantial. Meanwhile, American manufacturers are feeling the squeeze. General Motors and Ford both operate facilities in Canada and rely on Canadian parts and raw materials. If tariffs make those inputs more expensive, production costs rise. Car prices go up, sales slow down, jobs are at risk. Tech companies aren't immune either. Apple, Tesla, and others source components from Canadian suppliers. Higher costs mean thinner margins or higher prices for consumers, neither of which is good for business in an already competitive global market. Small and medium-sized manufacturers, the backbone of the American economy, are particularly vulnerable. Many lack the resources to quickly find alternative suppliers or absorb rising costs. Some may be forced to lay off workers. Others could shut down entirely. The stock market has taken notice. Investors don't like uncertainty. And a prolonged trade war with one of America's largest trading partners is about as uncertain as it gets. Market volatility has increased. Analysts are revising growth forecasts downward. The economic outlook is darkening. So where does this leave the United States? Faced with a deteriorating relationship with Canada, a Europe that's slipping away, and economic consequences piling up, Washington has a choice to make. One path is to double down, continue the tariffs, escalate the trade war, try to force Canada back to the negotiating table on American terms. This approach carries enormous risk. Canada has already shown it's willing to fight back, and with alternative markets in Asia opening up, it has less incentive to cave to U.S. pressure than it might have had a decade ago. The second path is negotiation, finding a way to de-escalate, crafting a new trade agreement that addresses both countries' concerns while preserving the deeply integrated economic relationship that has benefited both for generations. This would require compromise, something that's often in short supply in today's political climate. The third option is to turn inward, ramp up domestic energy production, reduce reliance on Canadian imports, and try to become more self-sufficient. On paper, this sounds appealing. In practice, it's fraught with challenges. Increasing shale oil production requires massive capital investment, faces environmental opposition, and would take years to replace Canadian heavy crude. U.S. refineries would need to be retooled, new infrastructure would need to be built, and even then, there's no guarantee it would be economically competitive. Canada, for its part, isn't waiting around to see which path America chooses. It's moving forward with its own strategy, strengthening ties with Europe, expanding into Asian markets, and reducing its vulnerability to American economic pressure. This is a fundamental shift in Canadian foreign and economic policy, one that recognizes the changing realities of global trade and energy markets. What we're witnessing isn't just a trade dispute between neighbors. It's a fundamental realignment of global energy flows, economic partnerships, and geopolitical alliances. For decades, the United States has been the dominant force in Western energy markets, the supplier of last resort, the ally you could count on, the power you didn't cross. But dominance isn't permanent. It requires maintenance. It requires trust. And when that trust erodes, when prices become unsustainable, when policies become unpredictable, when alternatives become available, the structure begins to crumble. Europe's pivot toward Canada is a signal. It tells us that the old rules no longer apply, that loyalty has limits, and that even the strongest alliances can fracture when economic realities change. It tells us that energy is no longer just about what comes out of the ground. It's about who you trust to deliver it reliably and affordably. The question now is whether the United States can adapt to this new reality. Can it rebuild the trust it's lost? Can it compete on price and reliability without wielding tariffs as a weapon? Can it find a way to work with Canada rather than against it? The answers will shape not just the future of North American trade, but the entire global energy landscape for decades to come. Because if America's closest neighbor and ally can successfully chart a course away from U.S. economic orbit, others will follow. And the world order we've known for the past 70 years will look very different indeed. The stakes couldn't be higher, the clock is ticking, and the world is watching to see what happens next. The great energy divorce between America and its allies isn't inevitable, but it's well underway. As pipelines shift, as contracts expire, as new partnerships are forged, the map of global power is being redrawn. Will the United States find a way to stay relevant in this new era? Or will it watch as the influence it once took for granted slips through its fingers? One thing is certain, the energy game has changed, and the players are no longer playing by Washington's rules. Thanks for watching. If this story opened your eyes to how fragile even the strongest alliances can be, hit that subscribe button, because the world is shifting faster than ever, and you won't want to miss what comes next.